you prepared for tax changes that could reshape your entire financial life? From April 2025, the UK is introducing reforms that go beyond minor adjustments. They strike at income, property, and even your family inheritance. For years, loopholes and allowances provided breathing space, but those days are ending. Whether you're a business owner, an expat, or simply working hard to build your future, these new laws will touch your pocket in ways you may not expect. Ignore them, and the consequences could be crushing. Pay attention, and you might still stay one step ahead. Number 1. The end of the non-dom regime. For decades, the UK's non-domicile tax regime allowed wealthy international residents to avoid paying UK tax on their overseas income and gains, provided those funds were not brought into the country. That system is now being abolished, with a new set of rules coming into force from 6 April 2025. Instead of being taxed based on where someone is domiciled, the government will move to a residence-based system, meaning anyone who lives in the UK long enough will eventually face UK tax on their global wealth. This represents one of the most significant overhauls of the tax framework in modern times, designed to raise revenue and close perceived loopholes. The change introduces a 4-year foreign income and gains regime for new arrivals. During this window, newcomers will not pay UK tax on overseas earnings, provided those funds stay outside the country. However, once those 4 years end, their worldwide income and assets will fall under UK taxation rules. For people who plan to stay in Britain long term, this shift could mean much larger tax bills than expected. Expats, entrepreneurs, and professionals with global income sources will find themselves needing to rethink financial strategies. The government argues this creates a fairer system, yet critics warn it risks driving away international talent and investment. This reform could reshape your financial future if you are an international resident or someone planning to relocate to the UK. Individuals who previously relied on the non-dom benefits may now face sudden exposure to inheritance tax and capital gains on overseas property. Practical steps include reviewing your tax residency status, evaluating whether you plan to remain in the UK long-term, and seeking tailored financial advice before the transition. Acting early may mean the difference between manageable adjustments and unexpected tax shock. Number 2. The 4-year foreign income and gains (FIGIG) regime. From April 2025, the UK will introduce the foreign income and gains (FIGIG) regime, a temporary relief aimed at people who become UK tax residents after living abroad. Under this system, new arrivals can benefit from 4 years of protection, during which they will not be taxed on overseas income or capital gains, provided those funds remain outside the UK. This measure replaces the older remittance basis system and is designed to make the UK more attractive to fresh talent and global professionals, even as the government closes long-standing non-dom privileges. For many newcomers, this is a valuable grace period, but it is also short compared to the lifetime benefits previously available. While 4 years may seem generous, the reality is that it passes quickly, especially for those building careers, investments, or family lives in Britain. Once the period ends, all foreign income, from rental properties overseas to international business profits, becomes fully taxable under UK law. This could dramatically alter long-term financial planning. For example, an entrepreneur who expected to shelter foreign earnings for decades may now need to restructure assets, transfer wealth, or reconsider how profits are repatriated. The shift puts pressure on individuals to plan carefully from the moment they arrive. For those who may qualify, the FIGIG regime provides a unique window of opportunity. You can use these 4 years to reorganize wealth, take advantage of allowances, and prepare for full UK taxation once the exemption expires. Ignoring this period could result in costly surprises, particularly when it comes to capital gains or large inheritances from abroad. The key lesson is clear. New residents must treat this regime not as a permanent solution, but as a countdown clock that requires strategic action before time runs out. Number 3. Worldwide income taxation for long-term residents. A critical change arriving in April 2025 is the shift to worldwide income taxation for long-term UK residents. Previously, individuals who qualified for the remittance basis could shield foreign income and gains from HMRC, provided those funds stayed offshore. that protection will vanish, meaning once someone has lived in the UK beyond the 4-year FIG window, their global wealth will be fully taxable. Whether it's rental earnings from a flat in Spain, dividends from a company in Singapore, or profits from an investment in the US, everything will now fall under the UK tax net. This represents a complete rethinking of how Britain treats international residents and their financial affairs. The implications are serious. People who plan to stay in the UK while keeping financial ties abroad may see their tax bills skyrocket overnight. For instance, a professional who has worked in London for a decade while maintaining overseas property could suddenly be liable for UK tax on both rental profits and any eventual sale of that property. Families with overseas businesses or investment portfolios will also need to reassess their structures. The government's goal is to simplify and create fairness, yet the reality for many individuals is a future where financial flexibility is sharply reduced and the risk of double taxation increases without careful planning. Practical preparation is now essential. Long-term residents should review their foreign holdings, consider tax-efficient structuring, and explore any applicable reliefs through double tax treaties. For some, accelerating asset disposals before April 2025 may be beneficial, while others might explore relocating or limiting UK residency. The overriding message is that complacency carries risks. Those who act now will be better positioned to manage this global taxation shift, while those who delay may find themselves trapped by rules that are far tougher than they anticipated. Number 4. New inheritance tax rules based on residency. Another major overhaul set for April 2025 concerns inheritance tax, IHT. Until now, liability has largely depended on an individual's domicile status, which meant many international residents could keep foreign assets outside the UK tax net. This will change with a new residence-based test, meaning IHT exposure will depend on how long someone has lived in Britain rather than where they are legally domiciled. Anyone who becomes a long-term UK resident will see their global estate fall within the scope of IHT, and even after leaving the UK, a so-called tail rule may continue to apply for several years. This shift could be devastating for families with wealth overseas. Imagine inheriting property abroad or holding investments built up over decades outside the UK. Under the new rules, those assets could face a 40% tax charge even if they are never brought into the country. Individuals who move to Britain for work or family reasons might unknowingly place their heirs in a much higher tax bracket simply by staying too long. The tail adds further complexity, as leaving the UK does not instantly free you from IHT exposure, creating lingering tax risks for years after departure. Preparation is vital. Those affected should review wills, succession plans, and cross-border assets as soon as possible. Strategies such as lifetime gifting, restructuring holdings, or using available exemptions can help reduce exposure, but timing will be critical before the new system takes effect. Families with international ties need to think carefully about how long they intend to remain UK residents and whether their current estate planning still makes sense. The new IHT residency rules are a wake-up call that ignoring long-term tax planning could leave your loved ones facing an unnecessary and crippling financial burden. Number 5. Higher tax on carried interest. From April 2026, the UK government will raise taxes on carried interest, the profit share that fund managers and private equity professionals receive when investments perform well. At present, carried interest is generally treated as a capital gain, often taxed at lower rates. Under the upcoming reform, it will shift into the income tax regime, meaning individuals could face rates of up to 45% depending on their earnings. This change aims to increase fairness, as policymakers argue carried interest resembles earned income rather than investment gains. For those working in private equity, venture capital, or hedge funds, the consequences are significant. A manager who once enjoyed favorable tax treatment could see their after-tax earnings fall sharply. The reform may also impact the UK's attractiveness as a hub for global investment talent, with some professionals considering relocation to jurisdictions with lighter tax regimes. Critics warn that reduced incentives could affect the flow of international capital into the UK, potentially limiting opportunities for growth in financial services, one of the country's strongest industries. The government, however, maintains that the measure ensures the wealthiest contribute their fair share. If you are in this sector, Careful planning will be essential. Reviewing remuneration structures, exploring tax-efficient vehicles, or even reassessing residency could become necessary steps. Employers may also need to rethink compensation packages to retain top talent amid rising tax burdens. For individuals, ignoring the reform could mean a dramatic drop in disposable income and long-term wealth potential. By preparing early, it is possible to manage the financial impact, but the direction is clear. Carried interest will no longer enjoy the privileged treatment it once did, reshaping the financial future of those who rely on it. Number 6. Frozen tax thresholds until 2028. One of the more subtle yet powerful changes affecting millions across the UK is the decision to freeze key tax thresholds until at least 2028. The personal allowance, the higher rate threshold, and other vital bans will remain fixed, even as wages and inflation rise. At first glance, this may not seem like a direct tax increase, but in practice, it acts as a stealth tax. As salaries grow over the coming years, more people will automatically drift into higher tax brackets without any official rise in tax rates. This process, known as fiscal drag, will steadily increase the tax take for the government. For everyday workers, the impact could be severe. Someone earning just below the higher rate threshold today might find themselves paying 40% tax on part of their salary in a few years, even if their standard of living has not improved. Families facing rising living costs could see their disposable income shrink further as the freeze quietly erodes the real value of allowances. Pensioners and middle-income earners will be particularly exposed, as even modest annual increases in income can push them into higher brackets, reducing both take-home pay and potential savings. The key to coping with these frozen thresholds is forward planning. Individuals should review salary growth, pension contributions, and investment strategies to minimize exposure. Making use of tax-efficient accounts such as IIs or pensions could soften the impact, while employees may wish to explore salary sacrifice arrangements for benefits like childcare or travel. Though less dramatic than headline tax rises, fiscal drag has the potential to reshape household finances over the next few years, slowly chipping away at disposable income. Recognizing the effect now is the first step toward protecting long-term financial stability. Number 7. Rising interest and penalties on late payments. Starting in 2025, HMRC will apply tougher rules on late tax payments, linking penalties and interest rates directly to the Bank of England base rate. With the formula set at the base rate plus an additional 4%, taxpayers who delay payment could face some of the highest charges in decades. This change reflects the government's push to encourage compliance while ensuring the Treasury collects revenue promptly. For individuals and businesses alike, the financial consequences of missing deadlines will become much more severe. The impact is especially concerning during times of high interest rates. A base rate of 5% would translate into a 9% penalty rate on overdue tax, rapidly inflating the amount owed. Businesses with cash flow struggles or individuals caught out by unexpected bills may find themselves trapped in a cycle of debt. HMRC has also been given greater flexibility to impose penalties earlier, leaving little room for error. This approach aims to deter late payments, but risks hitting ordinary taxpayers who make genuine mistakes or face temporary hardship. Preparation and organization are now critical. Keeping accurate records, setting reminders for filing dates, and maintaining a reserve for tax liabilities can prevent costly penalties. Those who anticipate difficulty should consider contacting HMRC early to arrange a payment plan, as ignoring the issue could escalate charges further. For households already battling inflation and stagnant wages, these stricter rules could turn a manageable bill into a crushing financial burden. The message is clear. Under the new system, lateness carries a price tag that could quickly spiral out of control, making timely compliance more important than ever. Number 8. The end of furnished holiday lettings relief. From April 2025, landlords will no longer benefit from the special furnished holiday lettings (FHL) regime, which previously offered generous tax advantages. Under the old rules, qualifying holiday lets were treated more like businesses than standard rental properties, allowing owners to claim enhanced capital allowances, deduct full mortgage interest, and benefit from favorable capital gains reliefs. The government is abolishing this system, meaning holiday lets will now be taxed under the same rules as ordinary residential properties. This marks a major shift for thousands of property owners who relied on those reliefs to boost returns. The impact is significant for investors in tourist hotspots across the UK. Without the FHL benefits, landlords may face higher taxable profits, reduced ability to offset costs, and fewer opportunities to claim reliefs when selling properties. Many who built portfolios around short-term lets could see profitability collapse, especially with rising interest rates and tighter regulations on the rental market. Some experts warn this change could push owners to exit the sector altogether, potentially reducing the availability of holiday rentals in popular destinations and raising prices for travelers. Landlords must now rethink strategy. Options include transitioning properties to long-term rentals, restructuring ownership to maximize remaining allowances, or reassessing whether to hold on to certain assets at all. Careful planning will be key, as the loss of FHL relief could erode profits quickly if owners fail to adapt. While the government argues this levels the playing field between short-term and long-term landlords, property owners face a future where their margins are slimmer and tax burdens far heavier. For anyone invested in holiday lets, April 2025 is not just a date on the calendar, it could be the turning point for their entire business model. Number 9. Stricter reporting requirements. From April 2025, the UK will enforce stricter reporting obligations for taxpayers, with new rules designed to improve transparency and accelerate HMRC's access to information. One key change involves the requirement for individuals starting or stopping self-employment to notify HMRC more promptly, ensuring that tax liabilities are captured without delay. Deadlines around certain disclosures are being shortened, while penalties for late or incomplete filings are becoming harsher. This reform reflects the government's broader strategy to close the tax gap by ensuring every source of income is properly declared. For small business owners, freelancers, and landlords, these changes could introduce significant administrative challenges. Missing a reporting window, even unintentionally, may now result in automatic penalties and additional scrutiny. The shift places more responsibility on taxpayers to remain proactive, with less tolerance for oversight. As digital record-keeping expands under initiatives like Making Tax Digital, the government is making it clear that excuses such as lack of awareness will carry little weight. For individuals already juggling complex income streams, the risk of costly mistakes is growing. The practical response is to tighten record-keeping systems and maintain a regular schedule for reviewing financial activity. Cloud accounting tools, professional bookkeeping support, or simply setting aside time each month to reconcile accounts can help avoid pitfalls. Those with multiple income sources, especially from property or overseas, should be particularly cautious, as HMRC's systems will cross-check data with increasing accuracy. The message is straightforward: staying organized and compliant is no longer optional, but essential. Under the new rules, failing to report correctly could turn a manageable tax obligation into a damaging financial setback. Number 10. Offshore trusts under greater scrutiny. From April 2025, offshore trusts will face sweeping changes that bring them under greater UK tax exposure. Previously, many non-domiciled individuals used trusts to protect foreign assets from UK taxation, sheltering both income and capital gains. Those protections are being dismantled. Under the new regime, income and gains arising within offshore trusts may become taxable on UK residents directly, removing much of the separation that once shielded beneficiaries. For families who built long-term plans around trusts, this shift could unravel carefully structured wealth strategies overnight. The risks extend beyond higher tax bills. Complexities around reporting, valuation, and cross-border compliance will grow, making it harder for trustees and beneficiaries to navigate their obligations. For example, distributions that were once lightly taxed could now attract full UK income tax, and gains within the trust may no longer remain deferred. Individuals who assumed their wealth abroad was insulated may find themselves unexpectedly liable, with penalties looming for non-disclosure. The government's objective is clear: close down what it views as unfair advantages, ensuring that offshore structures no longer provide tax sheltering for UK residents. For those affected, urgent review is essential. Trust arrangements should be revisited with professional guidance to assess how income, gains, and eventual distributions will be treated under the new system. Some may choose to restructure or even wind down trusts, while others might explore alternative vehicles better suited to the coming framework. The crucial point is not to delay. With the new rules fast approaching, individuals who act early can adapt their plans, while those who wait risk being caught unprepared by a system designed to make offshore wealth fully visible and taxable to HMRC. The changes coming to the UK tax system in 2025 are not small adjustments. They represent a fundamental shift in how income, wealth, and inheritance are treated. For decades, many people relied on reliefs, exemptions, and systems like the non-dom regime or the furnished holiday lettings rules to manage their finances. Those options are disappearing, and in their place are laws that bring more income, more property, and more global wealth into the UK tax net. Whether you are a professional with overseas investments, a landlord, or simply someone earning a steady salary, these changes will shape how much of your money you actually keep. The real danger is that many individuals will underestimate the impact. Frozen thresholds will quietly drag more workers into higher tax brackets, while inheritance reforms could hit families years after leaving the UK. Penalties and interest charges are rising, offshore trusts are losing protection, and carried interest will soon be taxed at far higher rates. These reforms are designed to raise billions, and that means almost no one escapes untouched. The good news is that preparation is still possible. By reviewing your financial plans, seeking advice, and acting before deadlines, you can limit the damage and even turn some of these rules to your advantage. The people who adapt now will protect their wealth, while those who ignore the warning signs risk harsh surprises. The UK's new tax era is coming fast. The question is whether you'll be ready to face it.